This is CRE Deep Dive, hosted by Dennis Bamford. We go behind the scenes of high-level commercial real estate, breaking down deal structures and advanced capital strategies, including self-directed IRAs that move investors from Wall Street into real assets, real deals, real execution, real control over your wealth. Let's get into it.
Welcome to CRE Deep Dive. Today we're with Chris Barnette from Inspira Financial, and he's going to give us the ins and outs of how we're going to transfer some money into an account for him.
Yeah. Thanks, Dennis. I appreciate it. Yeah. I'm the business development manager here at Inspira. Been with Inspira for about 4 years now. Inspira is one of the largest self-directed IRA custodians in the country. We have about 100,000 self-directed IRA account holders here currently and just north of 65 billion assets under management. So we're pretty large. One thing before we dive, I think one of the differentiators for Inspira is you're looking at custodians as you're exploring the idea of self-directed IRAs and if it makes sense for you. One of the things that separates Inspira is our ability to hold both traditional and alternative investments. So what that means, Dennis, what's great about that is you could invest in real estate, right? Private assets with your self-directed with us, but you can also invest in public securities. So we offer money market accounts, interest-bearing stuff, stocks, bonds, CDs. We do that all under one roof. So if you have some uninvested cash or you start getting some returns coming back from your alternative private investment, it's not just sitting on the sideline like a rock. You can actually park it into something interest-bearing until you're ready to make your next move. And that's huge because we're one of the only people. You usually have to choose, right? It's either I'm with Schwab, Fidelity, Vanguard, and I'm locked into the public securities, or I transfer over to a smaller custodian and they don't offer public. You can only do your alternatives there. So we offer the ability to do both. Less headache for the investor.
Yeah, for sure. So if someone were to want to do that, how long would opening an account take with you, and the initial rollover or the fees that go along with that? And maybe do you have annual fees, and how's that fee structure kind of?
Yeah, great questions. Let's jump right into it. So anytime we're talking to a new investor, I always say there's 3 steps, right? Start to finish. First step is going to be opening the account. We'll have a conversation, do a free consultation, talk about what you're trying to do, answer any questions, and then we'll send a DocuSign application. Once you fill that out, usually takes 1 to 2 days is all to get the account set up. Step 2 will be moving the money. So like you said, if it's coming from an old 401k, it's going to be a rollover. That's the terminology. If you're moving it from another IRA that you have or a Roth at Schwab, Fidelity, Vanguard, that will be a transfer. So rollover is coming from a 401k, transfers if it's coming from another IRA. So that process, that's the only variable in the whole process, is just because we're relying on another custodian. But typically we say rollovers take a little longer because, like you said, we're waiting on a check. That can usually take a week or two. Just full transparency, right? Because we're waiting on the snail mail sometimes and waiting for Fidelity to process it and get in the mail. And then you got to turn around and mail it to us and wait. So usually a couple of weeks if it's a rollover. Transfers can be much quicker because we can do a wire. So you can just liquidate some of those funds at Schwab, Fidelity, Vanguard, wire that cash over to us. So usually those can be 2 or 3 days. So what I tell people, once you get the money moved over, right? So set up the account, step 1, move the money in, step 2, and then step 3, you're locked and loaded. You're ready to make your investment. And it's really that simple. We help with the whole process, but yeah, it's usually anywhere from 1 to 2 weeks, depending on if it's a transfer or if you're waiting on a rollover check from a 401k. As far as fees, so we charge a flat rate fee. I love it. We're one of the only people that offer just a flat rate fee. It's $450 per year. That's one time annually, and that includes everything. So any of your transfers, purchasing or selling an asset, any us receiving the cash coming back from distributions or anything, that's all included. So people love that because a lot of people be flashy, right? They're like, hey, it's only $99 to have your IRA. And then they just nickel and dime the heck out of you, right? And it's just frustrating to people because they see, hey, what's this $25 fee on my credit card? So we tried to eliminate that. And I even make it sweeter. So we're actually doing something, Dennis. I didn't even tell you this, but this is great for your investors. We actually offer $100 off for anybody that would be investing with you in Odin Capital. Yeah. since we have a relationship. So for your investors, that would knock down the annual fee from 450 to 350. And that would
Okay.
be ongoing for life, not just the first year and then we jack it up. We would lock you in and give the $100 off every year they were investing
Okay.
with us.
And now that's per asset. So obviously we're talking real estate here specifically. So is that per asset? So yes.
Great question. So it would be 350 for the first asset, and then for each additional asset, you would we would add on $100 is all.
Wow.
So yeah, exactly right. So let's say you buy one rental property or your one multifamily investment, it's
Yeah.
350. If you're like, man, I really like this is great. I want to
Yeah.
move some more money in and do another investment. Now you're
Okay.
looking at $450 per year for
Yeah.
having both. And we cap it at 650. So you'll never pay more than 650. I don't care if you have 10 assets worth $10 million, you're paying 650. That's the other thing I like. There's no sliding scale. We don't penalize you because your account value goes up.
Right.
It's a flat rate fee just based on the number of assets.
Okay. All right. So, and then I'm trying to think of some of the other fees because I mean, like you said, they'll nickel and dime you.
Yeah. I mean, that's
So,
really the moving the
yeah.
money, the purchase and the sale of the asset are usually the big ones.
Yeah.
And again, like just receiving the money, right? People don't think about that, but that's one of the
Yeah.
fees that if you look at the fine print, sometimes they'll hit you right there. Okay, if you want us to receive an ACH
Yeah.
or some money from your quarterly distributions, we're going to charge $20 or something. We don't do any
Wow.
of that. The
Okay.
only other fee that you may see is if we're sending like an outbound wire, right? Like we can receive wires, but usually it's like a standard $30 fee just if you're wanting us
Yeah.
to move money via wire, but we can do ACH for free. And
Oh,
we do ACAT, we're ACAT eligible. So there's a lot of digital ways we can move money without having to charge anybody.
okay. That's fantastic.
That's
Yeah.
nice. Yeah.
Yeah. So we have a lot of military people that are investing and are getting ready to retire. Their thrift savings plans, the TSP, are they handled the same way or are they handled differently?
Yeah, absolutely the same way. Yeah, to any of your listeners, thank you for your service. Appreciate it. We have a lot of military. It's very popular, right? They get out, they have these TSPs and the money, and they have the option to roll those funds in just exactly the same as a 401k.
Okay.
Identical, Dennis. So yeah,
Yeah.
so definitely. Usually it's going to be a check. We just do a rollover, but and no other restrictions. Just think of it pretty much the TSP is just another employer program like a
Yep.
401k. It just happens to be the government, right?
Yeah. Yeah.
But no different.
And
Just great.
hopefully they don't take too long.
Yeah,
Hold your money.
exactly. Yeah,
Yeah.
I don't know. The government, I don't know. They'll hold your
Yeah.
breath on that. But it's
Yeah.
great, right? Yeah, for the same deal, right? For these military folk, they can have access to those funds and diversify and get out of the stock market if they choose and do real estate. So it's just a great opportunity. And I always like to tell people it's not all or nothing either, right? Let's say you come out and you have a pretty substantial account, it's 400,000. You might not want to put all your eggs in one basket, right? And say, hey, I'm just going to put all 400. It might make sense. But my point is, if you wanted to take just 100,000 of that 400K,
Yeah.
right? Or 200, you can do what we call a partial rollover. Leave
Yeah.
some of your money maybe in the stock market and then just move some of it to invest on the private side. So you have that option.
Yeah, that's the whole reason why. So about a year ago, this is the first time that I learned about the self-directed IRAs. I was blown away. I was like, "What? How come we all don't know about this? This is
I know.
ridiculous." You know what I mean? And so
Exactly.
I've been like on a mission to kind of help spread the word, and it's all about diversification of the portfolio. So you're not stuck
Yeah.
in just that. That your employer 401k, you have choices of either this fund, that fund, and you can't go anywhere else, and they charge you an arm and a leg. This way, you can split it out, like you said. The
Yeah.
$400,000, if they have that, you can split it up and you can put it in alternatives and you can put it in traditional. So
Exactly. That's the name of the game. That's what I love. That's what I do, right? I travel around the country. I do these types of shows with you just to get the awareness up because you don't know what you don't know, right?
yep,
But I love talking to people who they get excited about it, and I do too, right? Because
yeah,
the misconception is it's like, hey, you're right. I have this 401k. I'm not of retirement age, so you think it's just locked away somewhere,
yeah,
but it's not, right? You can
it's
move
not.
that money to another retirement account, an IRA, and there's no tax implications.
Yeah,
Your money's not locked up. You have access to it.
yeah,
So,
yeah. A lot more freedom with it. With
really,
that being said, let's see. So You're allowed up to 7,500. Is it 7,000 or 7,500 for with cash to roll over into your self-directed IRA?
Yep. So again, terminology piece. It's
Yeah,
all
yeah,
good.
yeah. I shouldn't have said.
So
Well,
you're
I
well,
as soon
yeah,
as I said,
you're spot on with the $7,500. That's
yeah,
the limit. That would be contribution, right? So that would be each
contribution.
year. Yep, is
Yeah,
you are allowed a maximum of a $7,500 contribution. That would be new money, cash going in to your account. And then if you're over 50, you get an extra $500. So if you're over 50, you get that catch up, and it raises up to 8 grand.
okay.
Now, the great thing is that's just new money. That's just the contributions. In terms of rollover, remember, rollover is if it's coming from a 401k, there's no limit there, right?
Yeah,
Because it's already in a retirement account. But just, yeah, $7,500 is your contribution limit each year to put into an IRA for new money.
yeah, 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 yeah. Okay, okay. So, purchasing real estate in an IRA, how would that look like? What would that look like, and what are the restrictions that we'd have for that?
Yeah, definitely. I love this. This is magic sauce. People, this is what people are like, how does it work? It sounds so like, how do I get the money and then I can pay the title company?
Yeah,
No, no, the money never leaves the IRA, right? So
yeah,
we're gonna be talking about step three now, right? First step was open the account. We'll
yep,
move the money in for step two, and then step three, we're ready to actually make that investment. And so what that looks like is we will actually set up the buyer on that investment in the name of the IRA. So we call that the vesting. So whether you're buying a single family home, a piece of rental property that you want, then this is how it's going to look on the title. Or if it's a multifamily or a syndication type deal where you're pooling your money, then it would be a subscription agreement. But either way, on either of those documents, it would read Inspira Financial, FBO, for benefit of the account holder, IRA, and their account number. So that would be the legal buyer, right? And then when we get to closing or on that subscription agreement, Inspire would send the account holder what we call read and approved document so that they can say, hey, I approve all this, but it's actually an Inspire team member that would sign the
yeah,
investment documents. And then we would wire the money directly from the IRA to either the title company or to the investment sponsor. And now the IRA holds that investment. And then any returns just flow or rent payments flow directly back into the IRA. So do you see what we did? The IRA sends the money, secures the investment. So it never comes out and goes into your bank account or anything like that, because then we're getting into a distribution if it ever leaves that account.
yeah, yeah, yeah,
So
yeah. Okay.
that's the magic sauce. That does that make, I know that was maybe a lot, but it's just all about how we set it up on the front end
Yeah.
to have the IRA as the direct owner of the investment, and then it's closed circle. All the returns go back into the IRA, not into your bank account, right?
Okay. All right. And so some of the investors, they'll go after smaller units, fourplex or even,
Sure.
100 unit apartment building, or it could be retail or whatever the asset is. We're going to have expenses.
Yep.
And so how are these expenses? How would we, what's the timeline for,
Yeah.
let's say that like a toilet breaks, what I mean? The single family home that they're trying to rent up all the way up to 100, 200 units. How do we cover these coming with the money coming out of your IRA?
Yeah, definitely. So that's a good point. So any expenses that IRA owns have to come from the IRA. So anytime I'm talking to people and they're like either doing a fix or flip or they're doing a long-term rental hold, I'm like, you want to have a little bit of extra money as a blanket in your IRA, right? Because like you said, little Johnny hits a ball through the window or the toilet breaks. You can't take money out of your checking account to help the IRA, right? The IRA has to cover the expenses and run on its own. Basically, how that works is we have a great portal that we use, and there's just like an expense pay button in our portal. So you'll be able to see your investments. If you can do a quick description, upload the invoice, and then we'll pay that contractor directly. But that's how we like to do it, right? Like it needs to come from us because we're the custodian and we'll help pay those invoices or those receipts that you have to make sure that the IRA is taking care of those expenses. It takes usually a day or two. Dennis, like our accounting team is on those quick. We know people don't have time to wait. So
Yeah.
you upload those receipts for reimbursement or the invoice, we're going to get those vendors paid, cut the check directly from your IRA. Again, that's the type of fees that are included in that $350 annual fee is for us to do this service for you.
Okay. Awesome.
Yep.
So, and with that being said, that like what type of loans could we get if we were to get a loan? There's certain types of loans we can and can't get.
Yep. Absolutely. So when you're using your IRA, there's really only one loan that an IRA can take out, and that's a non-recourse loan. And what that non-recourse means is the bank, they have no recourse to come after you as an individual, right? Because your IRA is completely separate. There's you as an individual and your cash and your money in your bank account, and then there's your IRA, which is your retirement account, two completely different entities. If you had that non-recourse loan and the IRA defaulted for whatever reason, the only recourse the bank could have would be to come foreclose on that property. They couldn't come after you or any of your other assets that you own personally. So that's nice, right? You have a little bit of
Yeah. Yeah.
protection. That investment is isolated just to that. Now, with a non-recourse loan, they usually want you to have a little more skin in the game
Yeah.
because they know that the only recourse is the collateral on that property. So usually they're going to want you to come in more like 30%, sometimes 35%, versus a traditional, 10 or 15%, 20% if you're doing it as an individual, just as a first mortgage or something. So that's one thing. And I know we were going to touch on a little bit the UBIT and the UDFI. A lot of people, it could be another one of those bad four-letter words, but it's really not. And I want to address the elephant in the room, right? I want to be real clear. UBIT, which stands for Unrelated Business Income Tax, and then UDFI, which is a subset of UBIT, is really where this comes into play. It stands for Unrelated Debt Financed Income whenever we're debt leveraged on a property. But UBIT or UDFI only pertains to the profits, right? So it's a good thing. We've made money. When what that means is that UDFI, same example, right? Let's say we go in and when we put 30% down on the house and then we get the non-recourse loan for the other 70%. We're debt leveraged 70% on that property, right? So if we make 50 grand on the sale of that property, basically 70% of that 50 grand in profits will be subject to some of that UDFI tax. So if you think the 50K, 70%, so maybe we're looking at the 35K out of the 50 is going to be eligible for some taxation, but then it's in whatever tax bracket you're at. So really to make 50 and then maybe have a tax liability of 5 or 6 grand really isn't that terrible, right? And the great thing is too, with the UDFI and the UBIT, you can take deductions. So if there were a couple of years, especially this comes into play with like multifamily and stuff, because there's some construction and some remodel that happens the first couple of years, you can take some of that depreciation and some of those costs to offset the UBIT UDFI to where it's almost nothing. And a lot of times our investors don't even have to pay it because you're able to take advantage of some of those deductions.
Yeah. Yeah.
It
Yeah.
comes into play, but I like to dispel it, right? It's
Yeah.
only on the profits. It's a lot better than losing your money, right? Or, you
Yeah.
know, leaving it in the stock market to make 1 or 2% and it's safe. This allows you to get into some of these real estate deals. But again, yeah, if you are debt leveraged, it can come into play a little bit. But it's not a game changer or I think anything that should scare people away, right? It's just
Uh,
something to be aware of.
yeah. That's wanting your cake and eat it too.
Yeah.
Yeah.
Like you
Yeah.
made the money, yeah. Now
Yeah.
it goes out the door. If you buy it completely, you get a
Right.
$200,000 little investment property, you pay all 200,000, beautiful. You have nothing. This
Yeah.
only comes when you're playing with other people's money, right? Which makes
Yeah.
sense. It just evens the playing field, right? To where
Yeah.
it's like, hey, if you're spreading out your money, that's great. You're debt leverage, you're just gonna there's a cost, you know how it is. There's a cost
Yeah.
to borrowing the money and using other people's money. So
Yeah. Yeah. I did skip over one thing. As we're wrapping this up, your LLC or the IRA LLCs and 401 or the solo 401ks.
yeah.
Could you kind of touch on those two?
Yeah, definitely. So anytime you're setting up the most simple way I can tell it to people, right? You can go directly through us, right? You're paying us that 350. We're going to be your custodian. So what you get is our oversight. So when you go to do that investment, like I said, step three, you're going to have my team, compliance, legal, just making sure all the I's are dotted, the T's are crossed, it's good before we send it out the door. You can absolutely do a checkbook control LLC or a solo 401k. Great accounts. And how that works is we would actually go ahead and still set up your IRA. This is for a checkbook control IRA. We would set up your IRA here and then however much you wanted, 50 or 100K, you would just go set up an LLC for the business. It would need to be set up in the name of the IRA, right?
Yeah.
Because if the IRA owns LLC, same vesting, right? Inspira Financial, FBO, your name, account number, that would be the owner of that LLC. Then we just send the money from your IRA to your IRA owned LLC. You have a business checking account linked to it, and you could do your investments straight from there. So now when you do that, I tell people, I give you the analogy, you have a loaded gun, right?
Yeah.
You have all the control, which a lot of people like, which is great, but now you lose our oversight, right? Because once we send the
Right.
money to your IRA owned LLC, it's
Right.
on you to make your deals, you do your investments, we're out of the picture. So
Yep.
option one, you got us, may take a little bit longer, right? Because my team's looking over the documents. We're paying those expenses through the online portal. You go to the checkbook control, you don't have any of that. You need to manage your own expenses, make
Yeah.
sure you're doing everything right. But it can be a nice tool because if you're doing more assets too, you get away from having to pay each additional asset, right? Because basically in our mind, the LLC is the one investment. And then from there, if you have 10 other ones, no
Yeah.
different than us.
Yeah.
So,
Yeah.
yeah. And then the solo 401k is just like the Cadillac daddy of them all, right? Because you're getting the same benefits of a traditional 401k, which is higher contribution limits. You can do traditional and Roth deferrals. You could take a loan out against a solo 401k. We don't really do them. IRAs is just our bread and butter. In a previous life, I know enough to be dangerous about solo 401ks, just not a line of business that Inspira really does, because it's really tough to qualify for the solo 401k. It's a pretty niche set of people, but if you can, it can be a great vehicle. A little more expensive, obviously, for the solo 401k setup and some of the reporting than a self-directed IRA, but that's the difference. I hope that's helpful, right? Checkbook control, you have the loaded gun, you set it up, you manage it all, or you just do the traditional open your account with us as a custodian and we partner with you and help you along the way. Just whatever you choose.
Yeah. Cool. Is there anything else you want to add? Is there something I missed that you want to put out there?
I think this is great, Dennis. I really appreciate you inviting me on. I would say to any of your folks that are listening, this is a great vehicle, right? To be able to diversify, especially if you're already passionate about real estate and doing some of this stuff on your own. This is just another source of capital. Another thing to consider, right, as you're thinking about your retirement long-term strategy is if you want to diversify, like you said, and get on the private side, be happy. Reach out to us. Absolutely no salesy, no high pressure. So on our end, would love to just have a 15, 30-minute conversation. If you're interested, want to learn a little bit more, talk about your personal situation, we'd be happy to do that with any of your listeners. We do that all day long, right? Here to educate people and help them figure out what's best for them. So
we'll have all your contact information in the bottom. So people, seriously, that's the fee that they're charging is amazing. Because I've done quite a few of these podcasts and I've talked to quite a few custodians, and the fee structure is real good at Inspira. So
I appreciate it.
Keep them in mind.
Definitely.
So, with that being said, Chris, I appreciate your time, sir.
Yep, you got it. Thanks, Dennis.
All right, man. Have a great day.
You too. Bye.
You've been listening to CRE Deep Dive with Dennis Bamford. If this episode gave you value, share it with someone who's ready to move beyond traditional investing and into real assets. And if you're an investor, operator, or custodian actively working with self-directed IRAs in commercial real estate and have real experience to share, you can apply to be featured on the show using the links below. We'll see you in the next episode.